Okay, investors, what's going on? Welcome back to Forward Finance, and today we're going to talk about how to get started screening for possible stocks, possible publicly traded companies, specifically in the United States, to invest in. All right, so let's get to it. So today we're going to talk about screening for stocks, screening for equities, and this I'm going to use the freely available FinViz screener available at finviz.com, and with it you can screen all of the stocks available on U.S. exchanges, New York Stock Exchange, NASDAQ. There's about 7,800 companies listed there. That's why before I set any criteria here, this is a tool. We can see there's 7,800 total listed. So we're going to start to narrow that down. Let me zoom in a little bit for you. So what a screener is and why it's important to know how to screen to start to search for investments if you want to invest in individual companies is that you can use criteria, financial metrics to narrow down what you're looking for. It's just a start. This is not the end of your search, but it helps you find candidates for investing when you want to do real financial analysis. So if you haven't already, if you have no idea what any of these things mean here, I will explain them briefly when I do them, but this is not going to explain in excruciating detail what they are. I did release another video earlier, the first series in this kind of thing, educational videos, about basic financial metrics, how to understand information on like a Yahoo Finance or through your brokerage firm, the basic information shown about your company like ratios, current ratio, PE, things like that. So if you haven't already and you don't know what any of those things mean, I recommend you watch that video first. The link is in the description. So let's get started. So basically with a screener, what I want to do is I want to set criteria based on what I'm looking for. And then I want to enter, I'm going to, in this case, it has drop-down menus. If you use it, there are other screeners available, like Yahoo Finance has a screener, investing.com has a screener, which are free. And then there are some paid screeners but I don't think you really need to, since the screening is not the last step, I don't know that it's worth paying for a screener. Maybe it's not, but anyway, people can comment and they can respond with their opinion, and if they find that some paid screener is worth the price or something like that, please let us know and down low and your opinion on that. But let me show you some basic ways that we do this. So there are a lot of things, and when you want to screen, when you want to start lowering this list here, because 7,800, we're not just going to look at the whole list and find something. We want to narrow it down by setting criteria for what we want to invest in. So for example, market cap, and as I mentioned in the other video, in the basic metrics, this is a basic financial metric. And the market cap is how big the company is in terms of its valuation by the market. So the number of shares outstanding times the price of each share, and that's the total value of, if you wanted to buy the entire company publicly on the stock exchange, you would have to pay at least the market cap. So for example, if the company is worth $100 billion according to the stock market, that's what you would need to buy all of it, or probably a little bit more, since when companies buy each other out, they have to pay a premium. So for example, I just look here, and let's say plus. So in this case, they have it here. I want to do. I don't want to buy micro like penny stocks. Let's say I want to buy small companies, meaning at least 300, small or bigger, at least $300 million market cap or higher. So if I click small, sets that criteria, and then we can see that already we're down to 3982 possible companies. That these companies now all have a market cap of over $300 million, as defined by this metric. So then let's say I want to only look at companies that pay a dividend. So I could try to find really high dividend payers, but remember, you don't want to invest just because something has a high dividend yield. It has to be a sustainable dividend as well, meaning supported by revenue and earnings. Or in this case, what I usually do, in my case, and if you don't care whether or not it pays a dividend, you can just leave it as any. You don't have to set, you can set as many or as few of these metrics as you want. You don't have to set all of them. You could even just use one if you want to. But in this case, I'm just going to set positive, meaning more than 0%, which just means that it pays some dividend. Anything more than 0 cents per quarter or per year. So then if I set positive, now we have 1,840 small or bigger companies that pay a dividend, and we'll just go on from there. So now another basic metric that I mentioned in the other video is current ratio, which is the liquidity ratio, meaning how much cash and things that can be turned into cash quickly within less than 1 year, the current assets, divided by the current liabilities, the things that the company will need to pay for within the next year. So, bills, payroll, things like that. So the current ratio is very important to make sure that the company is not at short-term risk of bankruptcy. And generally speaking, rule of thumb, usually for value investing or for financial analysis, you really want a company to be definitely over 1 on that. And if you want some margin of safety, meaning some insurance just in case something happens in the short to medium term, like revenue goes down or the company's sector or industry takes a beating or has headwinds, you want some cushion there. So for example, we set over 1.5 here, and that means the current assets or the cash and things that can be used will be cash in the short term can pay the bills relatively easily. The company has no problem paying its bills, paying its employees, paying for raw materials, parts, etc. And so now we set that, and we've eliminated more than another, I think about 1,300. Now we're down to 588 possible companies. So then, we can add some more metrics. Price to earnings ratio is another basic one, and generally speaking, a lower price to earnings ratio as opposed to a higher one is generally suggesting that the company might be of value. So usually you want to search for something under something. So let's say under 30. It'll only show me companies with a price to earnings ratio of 30 or lower. So if I hit that, and now we'll narrow it down, we've just cut out about 300 more companies. So now we're down to 238 companies. And let's add another one. Let's see. So another important thing on valuation is growth. So earnings growth, revenue growth, for example. So sales growth would be the equivalent of revenue growth. Sales is synonymous to revenue. So for example, if sales growth quarter over quarter, that means the previous quarter, 2 quarters ago to the most recent quarterly report, did they grow sales? Did their sales increase? Did their revenue increase? So if I want, I can even set a target. So it grew more than 5%, it grew more than 10%, it grew more than 25%, or I can just set positive so that there's some growth at all. And they're up right now, since we are coming off or we're still emerging from the coronavirus pandemic. It's probably going to be a lot of companies that meet this criteria. But now that I've set that positive for sales growth over the most recent quarter, we're down to 140 companies. So we're going to keep doing this until we get a nice relatively short list, a workable list where we can compare some investment candidates from the companies that we have. So let's relate to the dividend. And remember the payout ratio I also described. So that's the percentage of a company's profit that they actually pay out in the dividend. So remember what I said about a sustainable dividend. So let's say a company has a 15% dividend yield, meaning 15% annually of the price that you pay for the stock right now will be paid to you as a dividend over the next year if the dividend doesn't change. That's really high, and oftentimes when a company has a dividend yield that high or is showing a dividend yield that high on screeners or financial websites, stuff like that, it's because the dividend is at risk or is unsustainable or something like that. And one of the indicators that can help you judge whether or not a company's dividend is sustainable is the payout ratio, because this is the portion of their profit, meaning the actual money earned after expenses, the percentage of the revenue that they keep that the company can use to pay dividend that they are actually paying out as a dividend. So for example, if it's over 100%, then that would mean the company is paying all or more than all of its profit out as a dividend. So either they have to dip into existing cash, or they may even have to borrow money to continue to pay the dividend. If the situation doesn't change, such as revenue goes up or earnings go up, then the company will have to cut the dividend, reduce dividends. So we want to, generally speaking, the lower the better. So therefore, generally speaking, the lower the payout ratio is, the better. So let's say I set for under 60%. That seems like a reasonable. You can adjust this. This is just a suggested number. The values that I'm putting in here, they're not sacrosanct. You can adjust them based on your opinion or your research or your goals, what you're looking for. And so now it's okay, we're narrowed down to 115. So now let's look at, let's see, expected growth. So let's say earnings per share growth next year, or sales growth. There's a couple of options here. Let's look at this one. So this is the expected growth. So based on analysts' expectations, industry expectations, stuff like that. Is the company expected to grow earnings next year? We can say, if they're expected to decline in earnings, but we definitely want to avoid this, so we're probably not going to put this. But let's say we want to make sure that they are going to be able to grow earnings, or not make sure, but we're expected to grow earnings next year. Then we would put positive, and that means based on analysts' expectations, what they see, their indicators. They're doing some a lot of very highly technical stuff to figure out, or they are understanding the business of the company that they're looking at. And therefore the company is expecting to see higher earnings, higher profit in the next fiscal year. So this gives us a good chance, or a better chance, to possibly grow, have a good investment, as the company, generally speaking, revenue and earnings is, as it goes up or down, the stock price, generally speaking, over the long term goes up or down. So that's a good one. It's still at 90, so we still want to try to narrow this down some more. Okay, so let's look at price to book. So price to book, as mentioned in the previous video on basic stock metrics, basic financial metrics, this is the market cap of the company divided by the total asset value of the company. So all of the machines, land, buildings. It also can include non-tangible, intangible assets like intellectual property, goodwill. There are a few categories of that. And so generally speaking, for value's sake, the lower the PB, similar to the PE, the better. And the PE is generally, on average, lower than the PE. So let's say we don't want, it doesn't have to be under 1. It doesn't have to be at a discount to that. But let's say we want to under 5. You can try to find under 1. If I do that, it's not going to look. There's only 2 companies with a PB under 1, because that's not very common. It's not, especially in a market like right now. Markets are generally speaking at all-time highs nominally, so it's difficult to find a PB under 1. So let's make it reasonable, more reasonable, under 5 per se. And now we've narrowed down to 65 companies possibly to invest in. We're going to take a closer look, but that is promising. So let's get one more to try and weed out some things. So we want to try to avoid companies with a lot of debt, especially when there are record levels of corporate debt, credit card debt, consumer debt, household debt, student loan debt. There's almost, maybe even in every category you can check the numbers, but in many categories there are record levels of debt. Margin debt, I know, is one of them, which is relating to investing. Margin is people borrowing money to buy shares in companies or speculate. So long-term debt to equity is a good measure for that. So this measures the company's financial leverage. It's the long-term debt, so all of the outstanding bonds that are due in more than 1 year, divided by the stockholders' equity, so the value of the company retained by the stockholders, the shareholders. So generally speaking, as with some of these other things like PB and PE, the lower the long-term debt to equity is, generally speaking, the better. And it's good to try to make sure this is under 1. So we are going to eliminate some companies here, and we lost 11 companies there. So that makes sure that these companies aren't over leveraged. And so now we have some criteria here. We have 54 companies, and because of the criteria that we've set in the screener, all 54 of these companies, they have at least a $300 million market cap. Their price to book is 5 or less. They all pay a dividend. It could be, we're going to compare the dividend yields, but at least more than 0. They're all trading at a PE, a price to earnings, of less than 30. They all have a lower than 1 long-term debt to equity. They have a payout ratio under 60%, and they're expected to grow earnings next year. They have shown positive earnings growth over the last quarter. And over the short to medium term, they are all in good financial standing. They will be able to pay their bills based on the current ratio. So that's what we're showing here on this this list of 54 stocks that we have. And now we need to, what you would do next is you want to check more about these companies. Let's look at valuation, and we can compare things. We can rank them. So for example, I can rank by market cap. I just click on market cap. Right now it's showing from the smallest. Let's start from the biggest. So there we have the biggest company that we have is a $47 billion company, and then we can see specifically, we can see their PE, the PB, some other things, price to sales, that's price to revenue, price to cash on the books, price to free cash flow. We can see a lot of things. We can see, if we look here, we can compare by other things. You can compare by dividend yield. So let's see what the highest dividend yield. Look, there's a company with 18% dividend yield. But you don't want to get lured in by that. You want to make sure, you have to do some investigation. Why is it trading with an 18% dividend yield? Well, it might be because the market is expecting that dividend to be cut or to be reduced because it's unsustainable for one reason or the other. This company is in the oil and gas midstream sector, so it's probably a pipeline company. I don't know it offhand, DHT, but there may be reasons for that. Oil, I mean, it's coming up now, but so anyway, the point is you need to investigate. Why is this trading so high? Is this really, or in terms of dividend yield, why is it trading so high? Is this really an opportunity for income, or is this a very, very risky dividend play, and probably this dividend, it will be cut, or it may have already been cut, but it's just that the screener's information is not showing that yet. So you have to investigate all those things. And we can see, so let's see, let's rank it by something else. We can rank by current ratio, which we had screened for 1.5 over here. But let's see what happens there. So we have some company. This company has lots of short-term securities and or cash compared to its liabilities. 5.5 current ratio, so they have absolutely no problem paying their bills. We do have to check in the long term anyway. So this is a semiconductor company, might be worth looking at. And we can look more at the debt. So look at this long-term debt to equity. This is showing 0, 0. So this is, sometimes you might want to, this is an interesting thing. I do like to investigate these kind of companies. These companies are debt-free. They have absolutely no debt. That's why it's showing 0 here, which also coincides with the fact that they have very high current ratios, because this is no long-term debt. They still have to pay some bills. They still have employees. They still probably pay rent or maybe property taxes, depending on whether they own or rent their facilities. This one is a semiconductor, so maybe they do some manufacturing of chips and stuff. So those are very interesting. That might be worth investigating. It also pays a dividend, as we know. So those are the kind of things you want to look for, and it might be interesting to look at these debt-free companies. So that's what we can do. We can screen, we can arrange by whatever we want. We can look for high dividend payers. We can look for debt-free companies. I can even look at price to book. So if I go back to valuation, what's the cheapest price to book? Just press PB. So it'll be this way. So there's two companies here. Well, we had seen that before, but they are trading at less than a 1 price to book. So based on the book value of the assets that the company holds, the stock is cheaper on a per share basis than even the assets. That's not even considering the earnings or the revenue yet. So that also might be an opportunity for investing in something that is undervalued. So okay, so that's basically the gist of it. So I will go more in depth. You can use these screeners. You can mess around with things. If you don't understand some of these metrics here, some of them are technical, so I don't really care about them, like moving averages and volatility or stuff like that. That's about trading, wizards that like to draw lines on charts. I'm interested in the fundamental things related to earnings, cash flow, earnings, book value, price to sales, return on assets, all those kind of things that are relevant to the actual business underlying, not what the lines on the chart look like, because that doesn't necessarily have anything to do with the business underlying. That's technical analysis as opposed to fundamental analysis. So, okay, so check out my other video if you don't know some basic metrics. I have the link in the description below. And if you want to see more educational videos like this or analysis of companies, please check out the channel, subscribe, like the video, and I'll see you guys next time.